All right, let's talk about something that always makes Wall Street a little nervous. It's when a really respected, longtime market bull, someone who's been optimistic for ages, suddenly starts sounding the alarm. We're going to break down who this guy is, why his opinion matters so much, and what he thinks is coming next. This quote pretty much says it all, right? It all comes down to credibility. When somebody who has been consistently right about the market going up suddenly warns that it's about to go down, yeah, you tend to pay very close attention. So, who are we talking about? The analyst at the center of all this is a guy named Brent Johnson. And if you haven't heard of him, you're about to understand why his latest forecast is making some serious waves. First off, let's talk about his reputation. Johnson isn't your typical talking head. He's known for being rational, super accurate, and, importantly, he's not tribal. What that means is he follows the data, not a specific team. He's not on Team Bull or Team Bear for life, which, let me tell you, is a pretty rare thing on Wall Street. I mean, his track record really speaks for itself. But the key thing, the reason we're talking about him now, is what he did last year. While a lot of other analysts were predicting doom and gloom, Johnson stayed bullish, and he was totally right. That recent correct call is exactly why his new bearish forecast has so much weight. And here's the big twist. After playing the market perfectly as a bull, he's now saying a stock market correction is very, very likely. And that brings us to the big question we're going to dig into. Why? Why this sudden change of heart? Well, Johnson is a real student of market history. He's looked at all the big bubbles, 1929, the Dotcom bust, and he's basically saying, hey, I've seen this movie before, and the same patterns are playing out right now. He says that every single major market bubble in history boils down to the same three ingredients. You need sky-high valuations, you need tons of easy credit, and you need a really powerful story that everybody buys into. So the question is, how does today's market stack up against that checklist? First up, excessive valuations. Johnson looks at stock prices compared to the actual economy and what companies are earning, and he says, yep, they are at historic highs. So for him, that's a big check mark on box number one. Second, abundant credit. He points to things like the money supply, how much cash is sloshing around, and how much borrowing is going on. His conclusion? Money is cheap and easy to get. That's a check for condition number two. And finally, you need that big, compelling story. Right now, it's all about artificial intelligence. The idea that AI is going to change the world is fueling all this crazy optimism, which sounds an awful lot like the internet is going to change the world story we heard right before the dot-com crash, doesn't it? And with that, all three of his conditions have been met. But Johnson says there's another massive factor this time around, something unique to our modern market: the explosion of passive investing. He thinks these index funds and the algorithms that run them could be a hidden gas pedal in a downturn. So, what is passive investing? You've probably heard of index funds. Instead of a person, a human manager, picking stocks, these funds are run by algorithms. They're basically machines that automatically buy or sell whatever they need to perfectly mirror an index, like the S&P 500. Now, on the way up, this creates a really powerful feedback loop. A human manager can look at a stock that's soaring and say, whoa, this is way too expensive. I'm going to stop buying. But the algorithm? It doesn't have a choice. As a stock gets bigger and takes up more of the index, the algorithm has to buy more of it, which pushes the price even higher, no matter what it's actually worth. And here's where it gets really dangerous. That same logic works in reverse. When a stock starts to fall, a human can decide, you know what, I'm going to hold on, I think it'll bounce back. The algorithm can't do that. It is forced to sell to keep matching the index, which pushes the price down even more, which then triggers more automated selling. You get this downward spiral with no human there to hit the brakes. Okay, so what does a bunch of stocks going down on a screen actually mean for, normal people? Let's connect the dots from Wall Street over to the real estate market. It's actually kind of a mixed bag. First, the good news for some. Mortgage rates would probably fall because when investors get scared, they pull money out of stocks and park it in safer things like bonds. That could actually help the lower end of the housing market where buyers really care about that monthly payment. But for high-end homes, it's a different story. Sales could grind to a halt because of something called the wealth effect. When rich people see their stock portfolios shrink, they just don't feel as wealthy and they pull back on big purchases. And you can see this effect really clearly in certain places. Take the San Francisco Bay Area.
So much of the local wealth there is tied up in tech stocks. A correction on Wall Street is felt almost instantly on their main street.
Now, hold on. Before anybody starts panicking, it is absolutely critical that we add some context here. We need to be super clear about what Brent Johnson is, and more importantly, what he is not predicting.
He is forecasting a correction that's a standard, even healthy part of a market cycle. He is adamant that he is not predicting a 1929-style crash, some kind of Great Depression, or the everything bubble collapse that you hear a lot of other people warning about. And this might be the most important part of the whole story. Despite his short-term warning, Johnson is still, deep down, a long-term bull on the United States. He points to the power of the US dollar. He notes that, frankly, other countries have way bigger problems than we do, and he thinks that over the long haul, inflation will just naturally push assets like stocks higher.
So this leaves us with a really fascinating question to chew on. A market correction is supposed to be a return to normal. But in a world where algorithms, not people, are pulling more and more of the strings, what does normal even look like anymore? And what does it really feel like when it arrives?